All right. Good morning, everybody. Been waiting on this day all week. Been sideways for 2 days while the market was getting it all figured out. Today we have the opportunity for a gap close play. This tends to confuse newer traders because, well, they don't see a gap. So this is what we have the potential to see today. Doesn't need to go down. It can go up or down. But if you notice where the start of this candle, there's no real wick going in the other direction. So it went one direction and it closed near the end of that candle. We want price to go back to where we were at 8:30. That'll be the gap close. This one, we got there around 11 o'clock. Here's one going in the other direction. Same thing, 8:30, we got economic news. We didn't really get a wick in the other direction. And we closed near the end of the candle. And we got back to the gap between 10:30 and 11. Or another example, this one's actually CPI. Same thing, no real wick going in the other direction. We closed in the upper portion, not near the half, not even below the 75% mark. The next candle based and stayed inside that wick zone mostly. Then we continued the run. Then we based, came back, got it closed by around 11. This is what we're looking to play today. And even if you don't want to trade it, if I can save you from trying to buy calls at the open, thinking this was a really bullish move and we're going to continue to run, and then you buy calls and you get hammered, if I can save you from doing that, then it's a good thing. This was a non-farm payrolls from February 9th. And you can see how we closed really close to the midpoint. And we had, I mean, it wasn't a massive wick, but we did have some wick going in the other direction. This is not what we want to see. And sure, it got the gap closed, but it did it in less than an hour. And this is not what I'm looking to trade. So this is something that I like to trade. It happens intraday, happens all over the place. But when you know the time that it's potentially going to happen, like exactly at 8:30, it kind of dials it up a little bit, you know? So there is a difference between a gap close, meaning we closed last night at 4 o'clock, and then at 9:30 we opened up and we went back and closed that. There's a difference between that and this. So go back to your stats and see which gap we're talking about here, because this is a liquidity gap, meaning a candle opened and closed. And then we're going to go back to where that candle opened, not closing the gap from yesterday's close, right? That's an overnight gap fill that actually presents as missing candles, right? This isn't that. This is also what we don't want to see. So if we get big wicks in each direction, this isn't what I want, right? This isn't a gap fill that I would want to play. And if you think about it, why would we want to trade it? Price nearly came back and ended where it started. So why would we want to do that, right? This isn't what we want to see. As another example, this is not what we want. Another example, this is not it, right? So if we get anything that looks like that, we just scrap it because that's not the gap that we're looking for. Here's an intraday gap example. I did mention that they are everywhere. So this one happened at 10 a.m. Tell me the edge full stats on that gap close, all right? Here's another one that happened, well, I think at noon, 12:30. And then another one that we got at 3. The one that we got at 3 closed the one that we got at 10. The one that we got at 12:30 was closed by 1 o'clock. So these gaps, they're frequent. The thing is, a lot of times we don't know that they're coming, right? They just hit us, and then we can look back and say, oh, wow, that's a gap, right? Like this one at 12:30. We got data. We've seen this big candle move, recognized for what it is, and we can play the gap on it. It's a liquidity gap, not a gap in price. Markets are waiting on this. UK down about 0.5%. There's been some confusion when it comes to Hong Kong. They have more than one exchange, just like we do. Some of their exchange is closed. 2 of their 3 exchanges are closed, but not all of their exchanges are closed. There was some pretty good move in the overnight hours in those China names too, by the way. Dow basically flat, S&P at a quarter. Small caps not in the red. It's nice. And the NASDAQ leading by almost 0.5%. It's all about the jobs today. We're going to get some Fed members chipping their teeth, but it's all about the jobs today. And then there is the dock worker strike potentially being done or deferred really until January. Seems like they bottom out with a 65% increase in pay. Shipping is going to feel that. So we're going to get some data out of Japan next week. That's kind of big. And later today, we've got European central bank speakers. Seeing more talk about the Texas Stock Exchange too. It seems like they're going forward with that. It's going to be interesting. We'll have yet another exchange, right? Like we don't have enough exchanges already. So I continue to get questions on the average daily range. For years, I only had 1 day at a time. I didn't have the ability to look back and see previous days and do an examination, even a simple examination of just looking back at how the market responds around these levels. I get asked about statistics and, how often we do this or how many times we do that, how frequent. If you want those answers, scroll back and start counting and do the math, right? It's nice now that we have the ability to go back and see all these examples from the past and see how often we don't hit either side, right? Like this little zone here where we just stayed in between because we were waiting on data through that. So it happens. We'll go into these periods of time where we don't hit either side, and it's a part of the day's narrative that we say, we're waiting on data, like I did yesterday and the day before, saying it's very likely going to be a sideways day or a range day. We're not expecting to go anywhere. It gives us at least a little bit of edge on the idea that we're not expecting a breakout or a breakdown, that we know what to do with the edges of the trading day because we already have the expectation that we're not supposed to break out. And then, of course, if we actually do break out, then we know where we're headed. Destination trade, we're going at least to the ADR. If we make it through that, then we'll go to the full ADR, right, on down the ride. So we have the ability to look back now. And if you want to code it up and have something calculate it and do the math for you, that's great. I've got someone building this indicator where we can just look at the table. It'll have a table and it'll give us a percentage and some stats on how often we hit one side or the other, how often we, hit just the half versus the full, how often we completely overshoot it and close on the other side. Those will be great numbers when we get it, but I don't have it yet. So if you want those numbers, you got to do the legwork. Because those are usually the same kind of people who say, what's the stats on an evening star? How often does a head and shoulders work? You're going to have to crunch those numbers yourself. I don't get hung up on what the stats are, because you still have to be able to trade it. We're looking at the SPX here on a daily time frame, and these yellow lines are the non-farm payrolls. Now, I've got April, May, June, July. There's no reason to go back for years, right? But on these days, you kind of see the follow through of what we've gotten and how it can change the narrative. Coming out of a sideways range along these lows after non-farm payrolls. Same thing, stuck against the highs there. We were going sideways. Then the new week began and we were off to the races. On the day of non-farm payrolls, a lot of times, if you look at these, it's a doji day. We had a lot of violence at the open. We had that really big candle that I was showing you. And then after that, we really didn't get much. Doesn't mean that it's always that way. There's one here where it was really negative on September 6th. We had this one here, August 2nd. So it's not always a doji day. But if we get this really big candle today, it doesn't necessarily mean that we're going to get a follow through over the next couple of days or even the next week or two in the same direction. So that was a really good question. I built my events indicator and added non-farm payrolls to it. I think that September one really highlights how non-farm payrolls can be negative, and yet we still went the other direction over the next week or two. Or we could even say over the next month, because we're doing October's non-farm today. So over the month. Same thing with August. It was negative, and we went just a little bit lower, but then we spent the rest of the month running in the other direction. So those are the kind of questions that you want to have answers to, right? So that was a great question that someone brought to me last week. Try to do that work, right? All I did here is just mark the date and then look back and see what happened after that date. They are hedging this morning. I've seen, and I always see somebody say the data has been released early. It's been leaked. I see it all the time. And when I dial in on the people who say that and I ask them, where did you see it? Who released it? I always get some vague answer that doesn't really tell you anything. And their basic assumption is, well, we went up in the overnight hours, so it was released and it's going to be positive. Or, well, we went down in the overnight hours, it was released and it's going to be negative. What a load of trash. Just complete and utter trash. I'm sure it has been released, no doubt. There's always the sneaky idea that somebody is cheating and putting the numbers out there, or that somebody knows what we don't know because they know people that we don't know. But you're not going to find it on the internet in some tiny little hidey hole that nobody else knows about. If it actually is leaked, and it's happened where there's been leaks, it's all over the internet. It's on the front page of every newspaper. It's a big deal. If it was leaked and they knew the numbers, they wouldn't be hedging. Hedging is cost. They wouldn't spend the money to hedge if they already knew the answer. Plus, even if you do know the numbers, you don't know how the market's going to respond to those numbers. It's just like earnings. We can see a company had a fantastic quarter. We still don't know what the earnings is going to say about the next quarter. And we don't know what the market's reaction is going to be to what they have to say. So don't buy into the hype of, oh, it's already been released. It's going to be heavy or it's going to be light. We're going to go up. We're going to go down. They don't know. You don't know. I don't know. We don't have to guess. Just let the numbers hit and we'll trade what we get. Just like we do with earnings. Let the numbers hit. We trade what we get. So volume's a little light compared to what we have been getting, but it's not too light. If it was, say, under 40, I'd be concerned. And they are hedging, which is good. This isn't my assumption. I'm not guessing, right? This isn't my opinion. We know for a fact that they are hedging. We can see it. This is the market maker move up here at the top. You don't have to turn it on. It will show up there automatically if there is a signal that tells us we have a market maker move. And we can see that if you look at the front expiration and you compare that to the next expiration out. The front expiration has an 18 vol and the next one out has a 15 vol. That's a volatility average. When the front number is greater than the back number or the next number out, that's a market maker move. If you go online and you search for it, Schwab has a lot of the articles that were on the ticker tape from TD Ameritrade. They kind of just condensed it all into one big article. And it mostly talks about equities and earnings. And that's generally where we see the market maker move. But I use it in the futures. This implied volatility average, while we don't know all of the ingredients that they use to get this number, we know some of it. It uses all of the options that are out of the money on each side, and it averages up their implied volatility. And then it uses a calculation that involves the square root of time, and they get this number. There's some extra steps in there that they don't share. It's proprietary. Every broker has their own little secret formula. But it's the out of the money trading that changes the implied volatility on each of these strikes. If there's a lot of trading on a particular strike, that one strike will get a higher implied volatility. So out of the money hedging jacks up the implied vol on these out of the money options, which gets ran up into the average, and we end up with a market maker move. So we know they're hedging in the front end. We can also use this number and add it to the average daily range. So right now the range for the day is 64 points We can add another 30 to that. That's 94 points. $94 points. High to low. So that's what, 188 points from top to bottom. That's a pretty big move. The way I like to do it is just look at the edge. So we got 58.10 here. Go up another 30 points and draw your line. That would be your upside. Same thing on the bottom. Go to the lower ADR, subtract 30 points, draw your line. That would be the other side. And what that's saying is we could go that far today and it wouldn't even be considered an outsized move. You know, we're always trying to ask, have we moved too far, too fast? Have we overextended ourselves? Did we get too far away from the mean? This says that we could go all the way to 58.40 on the upside, and we still wouldn't consider that an overly large move today. It would get us near that call wall up there, 58.50. So we do have this central pivot range lower than yesterday's range, and price opened lower than the pivot. All of that is considered mildly bearish, but we're already above the pivot. And we're underneath the weekly pivot. The ES generally doesn't spend a whole lot of time underneath its weekly pivot. And the base case argument is if we make a move to the upside today, that we take that out and then we'll get above it and we'll struggle with these levels from Tuesday. Today's range on the central pivot is considerably narrow than the last 2 days, but it's still a wider range than we would want to see. It can be so narrow that you don't even see it, like these 2 days. There is a channel there. It's just so narrow that you can't see it. And that's as narrow as it can be. So when we look at those and then we look at this, sure, it's more narrow than the last 2 days, but it's not as narrow as it could be. And why does it matter? Well, these ranges on the central pivot offer a little bit of insight on the potential for today's trading. If it's a wide range, the expectation is that breakouts will fail, that they won't grow legs and we won't continue to move. On the other hand, if it's a very narrow channel, the idea is if we break out, we could really expand. Now, these channels don't make price do anything, so they're not the reason we're going to break out or not break out. And since they're not influencing the market, they can be wrong. We had this really wide day here, and we had that really big expansion. Now, granted, we did come back inside the range, but we broke the range and we continued to break down for a while before we did come back. So, you know, these ranges aren't perfect. They're just designed to give you an idea of what the expectation is. Much like the zero gamma or the spot gamma's gamma index. Same thing, it goes from a -4 to a +4. And the higher it is in positive territory, the more likely it is that breakouts fail. It's the same concept, only this is more old school, developed back before we had the ability to really quantify options data the way that we do now so easily. So I like to use them both. If both of these things are telling me that it's supposed to be a range day, then I'm much more likely to believe that it's going to be a range day, that breakouts will fail. Unless we get news, obviously, right? And if it's a news day and these things say that we're going to be sideways, I'm going to just lean on the news. But it really did help with Wednesday and Thursday, knowing that we were waiting on non-farm payrolls at the same time that we had a central pivot range saying we shouldn't break out. That makes sense. We were waiting on data. We shouldn't break out. And the channels say, hey, you shouldn't break out. Spot gamma was basically at 0, so that wasn't very helpful. But it wasn't at a -3 or a -4, which would have implied breakouts would grow legs and that we would really expand. Volume profile on the week. We are building out this shallow area here, which we'll see on the 10-day. But any move to the upside, we're going to have to deal with last week's central pivot around that 5780 area. And if we do break down, then 5692 cog line is going to come into play. This is a price gap between the 4 p.m. close and the 9:30 open. It's a different gap. 10-day, 30-minute volume profile still maintaining that D shape. And you can see that we've really lost the lower edge finally. So it's a much more compact zone. If we see a shift in the point of control, it's very likely going to roll up into this 5794 area. On the expectation that we don't stay in this zone through today's CPI data or non-farm payrolls data. So if we do stay in this zone, we're now building out. We were going to lose all of this, and that was finally going to move this pivot. But if we stay here and build out more volume, then we're adding more time to how long this pivot is going to stay at this location. So we're not looking for it to move anytime soon unless we can shift the entire zone up, say back up into this previous range, or we leg down. Because now that we've narrowed everything up, a leg down would expand the chart again and give us a chance to run into an iceberg lower, say somewhere around 5650. So an argument can be made about this point of control from yesterday. We didn't close through it. So there are analysts who will say it's still a VPOC, it's fine, because we didn't close through it. We wicked into it. 57.43 basically. So we did wick into it, but we didn't close on the other side of it. You got to think about why we're marking this zone in the first place. We consider it unfinished business. And the idea is that if we go back to the point of control from the previous day, it's marking where there was the greatest amount of trades that took place. You could consider it buyer's remorse, trader's remorse, that perhaps the people that traded at that place are very interested in getting a chance to trade again at that place. We wouldn't necessarily want to classify it as a support or resistance level, just as a significant area of interest, on the assumption that if there was a lot of trading that happened there yesterday, there's very likely to be a lot of trading if we get back there again today. One, we hit it in the overnight hours. Two, we didn't close through it onto the other side of it. So you could say this is still a potential area of interest. Now, we kind of opened underneath it and then jumped up through it. So I'm not going to consider it a VPOC. As far as I'm concerned, we hit it. It's no longer V, right? It has been touched. But I'm also willing to concede that it likely has value today. That if we go back and we hit this spot, that we could see a reaction in price there. So I'm not going to mark it today as a VPOC, because as far as I'm concerned, we've already hit it. But I don't think we've had a chance to significantly interact with those traders from the previous day. So it's worth putting it on there, 57.43. Since it's Friday, we have a look at next week's range. That range is not set in stone yet. It won't be until after the close today, but we get a little sneak peek and we get an idea. Have they priced in more volatility for next week or not? And we can see that the size of the range for next week is bigger than the size of the range of the current week, right? The line is higher than the box. Now that might change by the end of the day, but if it doesn't, it implies that there's a lot of unknown into next week that the market is concerned enough about that the volatility is continuing to rise. We were all waiting on non-farm payrolls because it was the biggest thing on the table. What's bigger than non-farm payrolls? We have October 10 CPI and October 11 PPI. That's next week at the end of the week. That's really about it. So we can see what the market is focused on, I suppose. If that proves to be true, then by Tuesday afternoon, very likely Wednesday, we're going to have these sideways days again, just like we did Tuesday afternoon, Wednesday, and Thursday this week. We went sideways waiting on this data, right? Waiting on today, the non-farm payrolls. We have a significantly narrow door too, by the way, although it is on the futures, and not really impressed with the outcome of the door on the futures. But day one open range, and I like to use 3 days. We are inside of that, but we're IX10 anyways. We need to get out of this box. We're still 2.25% above the 10-week. We're not overbought. We're not overstretched. We haven't moved too far, too fast, and we are generally fading back nicely, right? We're not getting ahead of ourselves, falling too fast or rising too fast. Everything is looking really good from this point. Now for the 10-day, we've been crisscrossing and back and forth above and below. No edge there. It could break either way. And then we're looking at least a 1.5% move in one direction or another. There's no reason to try to guess or assume or project which way we're going to go, because it's like earnings. We're waiting on CPI. We're waiting on the market's reaction to that data, to non-farm payrolls this week, CPI next week. We got to get it, right? So who knows? But I do like coming back to that 10. It's a nice reset, and it shows that we're not overextended. We're not overbought. We're not oversold. To me, it's like being back in the center of the basketball court. We could move a good distance in either direction. The VIX is still up 19.75%. It's almost 20% over the last 5 days. It's down 2% now, but it's still up almost 20%. So we've had a significant increase in VIX, and we're seeing it extend along the vol structure. China ADRs, they're up 4% today, and they're up more than 9.5% over the last 5 days. Solar's up, but not really going to get excited about. Solar energy still up. Bitcoin, airlines. This is a lot of growth. Growth value cycle, right? We would want to see the rest of these value plays come up and more of the growth names fade back. So for the value, we want staples, utilities, healthcare, building materials. We want to see more of those. And then for the Mag 7 space, we want to see less of those or less movement. Get a bit of a fade on those. Yeah, it's not looking good if we're looking for a rotation, because if we're going to see that growth value rotation, then I would really want to see utilities and healthcare, and we don't have it yet. At least they're not up enough. I noticed this morning that utilities was up pre-market, but it's not enough to hit the benchmark yet. Some of those Mag 7s are doing good this morning. Google up more than, well, Google was up. Yeah, they just gave it back. But Broadcom is still up. Amazon, Tesla. So we got a number of the Mag 7, not all of them, like Meta, it's not up enough to meet our qualifications. Still seeing gold struggle against this change in market dynamic. That was a significant move. I don't know how if it's going to be able to digest this and keep it or not. I mean, that's massive. But the range continues. So GTFO, right? Get out of the box. We could play the move. Otherwise, we are stuck waiting on data. And if we could play the gap, great. Otherwise, we get done with the gap. We'll line out yesterday's range. And do like we normally do, right? Because Wednesday and Thursday's range, really tight. This is the IX10. We got to get out of this box. So we'll get the event candle. That'll give us, hopefully, a gap close play setup. Once we resolve that, we got to resolve this range. If we can break above Tuesday's, Wednesday and Thursday's high, then we've got Tuesday's halfback. 57.77. Simple enough. Otherwise, if we break to the downside, we've got that Thursday after FOMC from the 19th. We'll focus on the low of that. You can see we've been resting on the halfback of that. So if we break this half, we're going down to the start, and it's a cog line 56.91. Of course it is. No reason to dig into the equities that are up or down or the rest of the sectors, because depending on how this jobs data goes, it's going to be the decider for growth over value, small caps over large caps, and whether or not we're playing commodities today or equities. Everybody be careful, be safe, have a good weekend. I'll see y'all Monday.